Here we are, episode 1 of the guest series. Hi, Bob.
Hello,
Good to see you.
Same here.
I'm pretty excited about this. Finally, we've talked about it for a while, and here we are having the conversation. And this is a little bit different. This is the episode 1 of our guest. What I'm going to have as a kind of a chapter or a theme of conversations with professionals in the consumer credit market. And in this conversation, I think you're going to be taking the lead in kind of interviewing me, just to give listeners a little bit more background as to on me, just in terms of where I'm coming from, how I have studied consumer credit all these years, because you and I have worked together for so long. And I think that's a lot easier way to kind of explain my background than, and it was your idea. I thought it was a great idea. Than for me to get on in front of a camera and just explain my background. I think that's going to be a lot more boring. So I'm looking forward to this conversation, Bob. Ready to get into it.
Okay, that's great. Well, we have worked together now, hard to believe, but it's pretty close to 2 decades. And Will and I actually are pretty complementary in our professional backgrounds. Will ran the consumer credit structured finance program at Moody's and as a managing director. And I was the complement in corporate finance, where I ran the industrial group. So many of the companies that I was responsible for actually originated paper that Will's team actually wound up rating. And so we had a lot of similarities, a lot of crossover. And we were together in investor calls and conferences many, many times. And as Will and I went to, as you know, Will, when we went our separate ways and had different chapters in our life, we continued those conversations over lots of wine and spaghetti, and concluded we should probably put some of that down on camera for posterity, because somebody might be interested in all that. So we thought we would do that, and we flipped the coin and agreed that I think I flipped it several times, but agreed that Will should be be interviewed. And so I know that I'm going to come up on camera the next time around. So I'm going to be provocative but gentle, because I know that I'm going to be on the other side of things as well. So this is all about consumer credit. Those are words: consumer credit, and together, consumer credit pretty simply rolls off our lips, but they're intertwined in our lives, but they mean a great deal. So we're going to try to get into all that. And I'm hoping that through our conversation, as we've agreed, that there's going to be some rational approach to understanding what consumer credit is and how consumer credit is affected by developments. And I think when we're done with this, the listener will know that those developments are not cause and effect, and certainly not linear. So we're going to talk about a lot of different things, but I hope the listeners are patient, because we're always going to get ourselves back to consumer credit.
I mean, that's a good point, Bob. Sorry to interrupt, but this is meant to be a long form kind of conversation, and free ranging. So as you know, you and I know, but maybe the new listener doesn't know, this is unscripted, right? And we are going to just see where the conversation goes. And you're right, it's focused on consumer credit. This channel, this podcast, is really was motivated by a newsletter that I started about a year and a half ago, that is published on LinkedIn. It's called The Consumer Credit Matters. And that was really that platform and that medium, meaning written material, written analysis, was my foray into kind of putting my thoughts together, and publishing them to the broader community, and just seeing where that landed. And I've been pleasantly surprised to see engagement from any number of professional and I think non-professional angles, frankly, an interest in the topic of consumer credit. So this podcast is meant to be an extension of that. And it's not really, I know that we're on video here, but it's not really meant to be a video centric a video-centric production. We'll also be broadcasting on the audio formats in Spotify and what's it called, Apple Music. But it's really about the content and the quality of the conversation, as you said.
Good. All right. Well, let's start right at the top because we're going to keep coming back to this. And as someone who spent your life in consumer credit, we'll talk about your life in just a moment. But what is consumer credit, and how should the listener, and most of the people who are listening to this are finance professionals, but it's pretty broad about what that the audience is going to be. But how would you define consumer credit? And for those people who are finance professionals, would like to work about statistics.
Yeah.
So how would you broadly define what is consumer credit? And what are the statistics and measures as to think about the health of consumer credit, if you will?
Sure. I mean, look, I think consumer credit, first of all, it's a very meaningful part of all of our economic lives. It is consumer spending is more than 2/3. I think it's 70% of the economy is generated from people spending money in this country. A very large part of that spending is done on credit. And that part of it is really my intersection with consumer credit. How do people spend more money than they have? Nobody spends more money than they have quite like Americans do, and that is called credit. And so this universe of credit, broadly defined, is, first of all, I want to make the case that it's enormous. By the way, by the latest measures from Federal Reserve, it is $17.5 trillion large. That is a record amount of consumer credit outstanding. And the categories of consumer credit are broad. In broad terms, mortgages are the biggest form. Residential mortgages are the biggest form of consumer credit. That's about 71% of that 17.5 trillion outstanding, for example. And then much smaller, but still significant in size, portions of consumer credit are credit cards, auto loans and leases, student loans, very large. That's 1.7 trillion in and of itself. And then home equity lines of credit, a much smaller portion. And then there's an other category, which includes things like personal unsecured loans and those things. That's how I would typically define it. There are other, call them shades of gray in the economy that some people would also classify as consumer credit. For example, I think, maybe small business loans, depending on how small the small business is. Certainly, sole proprietorships kind of act and are also often treated as if they were consumer credits from an underwriting and performance perspective. They have a lot of the performance characteristics that align themselves with consumer credit. That's an example. Mm-hmm. Other forms of consumer credit, they're a little off the run, so to speak, or a little less large and popular, might be solar loans or solar leases, rooftop distributed solar, mobile phone financing, mobile phone plan financing is another example. Rental car, sometimes rental car assets are sometimes thrown in there as well. So there's a lot to talk about in this space, which is, by the way, what I have found throughout my career, 25 plus years at Moody's alone, following consumer space, I found to be incredibly rich kind of material and intellectually stimulating material to mine day after day, because look, not a day goes by where you don't pick up, the newspapers, the Journal, the Times, the Financial Times, whatever newspaper of your choice is, and you don't see, at least a couple of articles that intersect with this universe that I'm talking about. It's in your face every day, and understanding that on a deep level helps, I think, really the economic world come alive, and understanding that it just makes, I think it just stimulates, like I said, it's just intellectual fodder for each and every day. So that's something that's kept me motivated over the years.
Good explanation about what consumer credit, about what it is. Why don't you tell me, because I only know marginally the answer to this, is how is consumer credit right now? I mean, talk about what the health is. And what, how would you think about availability of consumer credit, growth of consumer credit? Are the consumers keeping up with their promises? So, how is it? How healthy is consumer credit right now, and how do you measure that?
Well, this is a really big topic. I'll try to keep my answer succinct, and you can dive in, because um, I kind of characterize this the current context of the economy and consumer performance as a paradox.
Hmm.
So what do I mean by that? If you look at, broadly speaking, the broad measures of the macroeconomic environment in the US today, you have an economy that is punching above its weight, meaning, it's growing above the long-term historical average. It has been in the last several quarters. Why is that significant to consumer credit? Well, as I mentioned before, more than 2/3 of the economy is consumer spending. So consumers are spending. Now, as I also mentioned, consumer credit is going up, which should raise concerns about, are they spending too much on credit? Are they over leveraged? That is a legitimate concern. And certainly we know from, if you compare, say, 2019 to, where the data ends around end of 2023, if you compare things like the average monthly auto loan payment, or the average credit card balance and interest rates associated with those credit card balances, or if you understand, for example, that the almost 4-year payment moratorium on student loans ended late last year, and now consumers have to write a check. 40 million student loan borrowers out there have to now get back into the habit of writing their student loan checks every month, and that on average is $267. What I'm trying to say is, all of that adding up is a lot of incremental expense on top of all the other impacts of inflation, on groceries and gas and shelter, in particular rental shelter, and we'll get to that, I'm sure, in more
Mm-hmm.
detail. Those are kind of, call them headwinds for the consumer. However, the other side of that people forget to talk about when you talk about the strength and resilience of household financial profile is inflation has also helped on the income side of the equation. And I like to look at a debt service ratio that the Fed puts out to kind of put kind of both of these sides of the coin together. It shows the debt service, as the name would suggest. The debt service ratio is the debt service for all these consumer products that I just mentioned: mortgage, credit cards, student loans, and so on, divided by the personal disposable income. So there you have the income component to it. And that definition of that ratio, I mean, the lower that ratio is, the better. That means the lower your monthly debt service is to your income. That is at an historic low right now for the country. So again, when you talk about real strengths in the economy, it's growing because consumers are spending. They must have some confidence that they can continue to spend and spend on credit. Why is that? It's because, at least in part, income and wages have also increased. Now, importantly, wages and income have not increased to the point where kind of economists' worst fear have come to realization, meaning the wage price death spiral that is very, very hard to correct without a lot of economic pain. That has not taken root. Knock on wood, because it could still happen. But wages and income last I looked, the inflation rate, it's coming down. It's not where it was prior to the pandemic, but it's moving in that direction and it's getting close. So that's a positive kind of it's a positive fact that supports that the consensus view now that we will eventually achieve a soft landing. But as we know, this last mile, as they call it, of the soft landing is going to be bumpy, and it already is proven to be bumpy. Given the print we just got on inflation just a week ago. So that's another. I think that's a positive, right? That shows the households are resilient. However, that resilience comes, one of the reasons for that resilience has to do with what I call the pandemic mortgage refinancing boom, where 75% of people who have a mortgage refinanced their mortgages during this really low rate environment we had just in the early stages of the pandemic, but certainly prior to the pandemic. Historically lower for longer rates. And again, 75% of mortgage holders refinanced during that time. And I can go into that a little bit more, but that's another strength for those who had a mortgage, right? For those who don't have a mortgage, which is 35% of the population or 35% of households, they were subject to the prevailing winds of rental or shelter costs and rent inflation, which have been very, very high. So they are not in the same position as homeowners, for sure. And then the other thing that you have to mention when you think about consumer credit is the labor market. And the labor market is, let's take a picture of it right now. It's picture perfect. It's hard to imagine a stronger labor market right now along almost any measure. And I look at a lot of different statistics when it comes to the labor market, but certainly the headline statistic, the unemployment rate notched down last print, I think 3.8%. It's very low by historical standards, by historical norms. The employment, basically the employment market suggests that we're at full employment. And again, we're punching above our weight in terms of job creation. Those numbers come out every month and are surprising more often than not on the upside to the consensus view. And the concern, of course, would be, well, if you keep adding jobs higher than consensus, aren't you going to stoke wage inflation, which again, you want to avoid? And that hasn't happened. And the latest kind of narrative around why that hasn't happened has to do with outsized immigration, either from the southern border, from undocumented workers who can and do work in this country legally, or just from the normal immigration channel. So that is kind of the part of the equation here that I think at least I like to be aware of, to kind of explain and better understand how we can have all of this wage or job creation without wage inflation, at least so far. So those are all, and by the way, and then one last thing I'll mention about the macroeconomic, I know I'm going on a bit here, but the macroeconomic environment or the underwriting environment for macroeconomic statistics is quite tight and has been for the past year and a half or so. So that also bodes well for the performance of consumer credit that has been underwritten in that last year and a half. Okay, that's the positive stuff. Those are all tailwinds. What are the headwinds now? The why did I call it a paradox? The paradox is that consumer performance in some of the major credit categories is terrible. And I'm not using that word lightly. It is really, really struggling here. So, for example, credit card and auto loan delinquency rates are not only higher today than where they were just prior to the pandemic, but they're on a very steep upward trajectory. And, at least in the case of auto delinquencies, are approaching where they were during the great financial crisis. And I want to pause here because that is astounding. if you think about what I just said, that we're even talking about, approaching, not tomorrow, but, down the road, if you continue on this path, I know that's a lot of ifs, but you're approaching where you were prior, in the great financial crisis, which is kind of a milestone that you do not want to achieve again. And it was a very, as you know, Bob, it was a very, very different market then in terms of how weak it was compared to the macroeconomic environment today.
Let me ask you a comparison there for those of us who remember that great financial, because there was a very remarkable difference that what among the many things that led to the great financial crisis was super, super, super easy credit at the consumer level. So people took on the credit and then couldn't perform. While credit has been available institutionally the last number of years, and one could say it was an easy credit environment because rates were
Mm-hmm.
low, I think the underwriting was actually pretty good, meaning the underwriters at the banks, the commercial banks that were giving small business loans, consumer loans, even big corporate loans, not necessarily their own doing. They were regulated to have to do that, but it was the credit was metered out the last number of years better, if you will, more judiciously than the credit was metered out in the years leading up to the financial crisis. Yet what you're arguing is the consumers aren't performing. Why do you think that is?
Well, there's a few things going on that muddy the waters. You're right. Underwriters were, and also there's a mystery here. I mean, so I don't have all the answers, but I have some of the explanation. I think that, in the pandemic, the thing that muddied the waters the most was all of the subsidies, federal subsidies and fiscal transfers directly to consumers, and the relief measures that were also provided, again, from the government, as well as servicers and even private collectors and servicers and
Mhm.
so on. And, it's easy to forget now because it was so brief and now it seems so long ago. But if you recall, in March of 2020, when the pandemic was just breaking news, unemployment rate shot up into the teens.
Mhm.
Everyone who had been through the great financial crisis, myself included, had deja vu all over again. And they were thinking, oh my goodness, this is going to be a repeat. We're going to have tens of millions of people without a job and without income. We didn't know about the federal subsidies or any of that, that relief coming yet. And we didn't know how effective it would be because the relief measures that were put in place during the great financial crisis were, of course, not aimed so directly at the consumer. They were aimed more at the corporate world, right?
Mhm.
Um, and with the thinking then that it would eventually help consumers, it would eventually help Main Street. That's a whole nother podcast as to how effective that was. But we can
Mhm.
certainly say that what happened during the pandemic was, at least in my mind, unexpectedly effective, um, in terms of uh, the just the speed at which it got into the hands of the people who needed it at that time. Now you can argue that it was too much and it went on too long. Okay, in hindsight, that's an easy thing to say, perhaps, or debate, but that did come, and you saw the unemployment rate come down just as quickly as it went up. It was truly a spike. And during that time, all of that is to say that during that time, underwriters needed to navigate those waters, and so they erred on the side of conservatism. And so you did see underwriting. There was a brief time of underwriting loosening, and I can get back to that. But by I think the end of 2021, underwriting was tightening again, and I think there was the consensus view was is that they were waiting for some kind of shoe to drop around borrowers who may be overextended and that ultimately wouldn't be able to repay their loans. And by the way, that probably wasn't misplaced, because there is this cohort, and that was all based on inflationary concerns, right? Because by the end of 2021, certainly inflation was headline news, and people were concerned about, well, how high is it going to be? We hadn't started talking about a soft landing. Like, the consensus view was it was going to be a hard landing, and unemployment was going to go right back up, and so on and so forth. So a lot of surprises and a lot of, ups and downs over that period. I think, long-winded answer to your question, but I think that's why you see these kind of this strange, maybe odd behavior, um, uh, and kind of paradoxical kind of um, behavior among underwriters and performance over that period of time.
Interesting. We'll leave this. We'll come back to this point. But what you're saying, what I'm taking away from it is, I think it's actually worse today, because I think that the underwriters, the people who the entities that were providing credit to the consumer in the last couple of years, were conservative, comparatively conservative, particularly conservative relative to the time before the great financial crisis. And I think the jury is still out about what they did today versus during the pandemic lockdown events. Yet, even with more judicious allocation of credit, the consumer performance with that credit is worse than it, or getting to be worse, or approaching as bad as it was during the great financial crisis. So I'm actually kind of worried about that. But I want to come back to a statistic. So there were a lot of things that you covered, but for somebody like me who's not deeply ingrained in the consumer credit and wanted to get a sense about how is consumer credit, where's a good place to go? And I tried to answer that question for myself, and I looked up the Fed's H19 release, and it's pretty good to me. And I looked at it, and I'm curious what you think. Is that a really good place to go to assess consumer credit? Because I looked at the growth of consumer credit January and February of this year, which was about 3%, right, roughly, which is about the same as the growth in consumer credit, meaning the utilization, as what it was a year ago. And that's roughly in line with overall GDP. Now, they're not exactly, but so for somebody who's not steeped in consumer credit, yet I wanted to assess the quality of consumer credit today, is that a very good statistic, or would you direct me someplace else?
No, that's certainly one of the best kind of reliable, high quality resources to get a big picture view. But honestly, it seems to me that there's just a countless number of good sources for quality data and information and analysis. The Federal Bank of
Do you have a couple of
the Federal
ideas?
Bank of St.
And then again,
Louis.
I'm from the standpoint that I'm not a consumer credit expert, yet it's crucially important to the economy. Where would I go?
Yeah, I would go to the Federal Bank of St. Louis. Their website has a very surprisingly, I guess I'm a
Yeah,
little bit surprised, because it's a government, essentially a government site, but
it's pretty fulsome. I've
got a
used it in
lot
lots
of
of other
bells and
roles.
whistles that allow you to do a fair amount of data analysis, and they have a lot of different feds and other private companies that share their data on this kind of centralized platform that is pretty easy to use.
Good. So with that framing that you laid out, some positives and negatives. You talked about the paradox. I'm going to ask you to comment on a comment made by another titan of finance, Jamie Dimon. And I was reading Jamie's letter to shareholders a couple of weeks ago, and it was a pretty sobering letter, but it's also a very interesting letter because it gives the opportunity to hear what somebody individual at that level really thinks beyond commenting just from his institution standpoint. And he made a quote that stuck with me, which was, "The chance of a bad outcome in the future is higher than people believe it to be." What do you think of that?
Well, he's probably pointing to some of the things that I just, rattled off in this kind of juxtaposition or paradox in consumer behavior. Suggests that there is a kind of a soft underbelly to the macroeconomic strength that we're seeing at the headline level. I kind of would put it in this way. I mentioned that headline delinquency rates, for example, in some major consumer credit asset classes is deteriorating at a pretty shocking rate in the context of the economy. Again, imagine if we have a hard landing instead of a soft landing, and unemployment goes up by not a tenth of a point or two, but by a couple of percentage points. Or these are not like off the reservation thoughts. This is something that is hanging in the balance for sure. And I suspect, if that were to happen, I mean, there's no doubt in my mind, given the historical correlation between unemployment, just that simple dynamic, and delinquencies and losses in consumer credit, right? If you have a job, you're much more likely to pay your credit back. And if you don't, you won't, or you can't. So, you can imagine if the chance of recession is not, I'm not talking about the chance of recession this year, but, the chance of recession or a hard landing next year for reasons, as almost they always are, that you can't really put your finger on today, that softer underbelly will manifest itself in a way that could be quite ugly. Much uglier than perhaps we've ever seen, simply because what we're seeing now is quite shocking given the strength in the economy. Again, we can explain it. It's partly being driven by those who are less financially resilient in our country. And I mentioned that, renters is an easy kind of category to talk about. But there are other categories of weakness that I call them intersections of risk, and here I'm referring to younger cohort borrowers as a category. I'm thinking Gen Z and millennials, right? So those borrowers generally don't have. Well, first of all, they're weaker always. So I don't mean to say that part is new. But what you are seeing is that the deterioration among those cohorts is the deterioration is much steeper than what you're seeing from the older cohorts. Why is that? Well, we know these are weaker because they haven't hit their peak earning years. They haven't had a chance to build up savings or reserves to kind of navigate any choppiness in their financial lives. That's why they are riskier borrowers to start with. But on top of that, they were not able to participate then in this, what I refer to as the pandemic mortgage refinancing boom. And therefore, they are left more vulnerable, again, to the prevailing winds of the rent inflation. And that's putting hardship on those cohorts all around. So that's intersection risk number one. Second one is around underwriting. So underwriting, I mentioned that it had been strong in the last 7 quarters or so. By all indications, it had been strengthening. It had been stable to strengthening, say by FICO measures over time series data. However, if you go back to 2020 to 2021, roughly speaking, during that time period, when there were a lot of fiscal transfers and subsidies going on, there was a solid 6 quarters of underwriting loosening going on. And that created some weakness in the collateral that was generated, the loans that were underwritten during that period of time. That is manifesting itself now, right? It takes time for those, call them bad decisions, riskier decisions, to start to manifest themselves in terms of delinquencies and losses. So at least some of what we're seeing is also caused by that. I guess the good news there is that will eventually burn out, because it was only for a limited time, 6 quarters, as I mentioned, before underwriters realized that there was something to worry about here, and they started to tighten. Okay. So that's two of the intersections. What's the third one? The third one is just subprime. Subprime borrowers. And here, I've looked at the data where you split out just the FICO scores of borrowers at 620 and below. So the deepest subprime borrowers out there. And there again, you're seeing that cohort of borrowers, their delinquency rates and losses, separate on an accelerated basis relative to some of the older cohort borrowers. And that might be an exaggeration. There's some studies out there that suggest there's some FICO migration going on that can explain at least some of that, maybe a lot of that, but not all of it. And again, I would go back to there are cohorts of borrowers out there, mainly the non-homeowners, who were not able to participate in some of this resilience building that I referred to. So I would just say, in terms of the household formation delayed among the younger cohort borrowers, who are probably also, in higher proportion among the riskier borrowers, that is household financial resilience denied in this case. And I think that's a large part of what we're seeing.
Interesting.
The other thing about, that I would say about Jamie Dimon's comment that I saw, that he's also suggesting that, geopolitical forces, there are a lot of kind of worrisome hotspots, if not warm spots, throughout the world for us to be concerned about, that could have, that could get amplified, it seems like, on any given day, right? With very consequential effects to the global economy. And so that is also kind of an X factor to all of this, all of this math, all of this calculus that we're doing, for our domestic situation.
Interesting. Well, a lot of topics we're going to still be able to get into. And I guess one of the things I took away from Jamie's comments were, and it might be overly paraphrasing it, but the market's not always right. And I think he's saying, just because we all think we hear what commentators are saying, there's a better chance, for all the reasons you're bringing out, than most people think, of some bad outcome occurring rather than a good outcome occurring. But I want to think about one bad outcome and get your views on it. You drew the connection between performance of consumer credit, past dues, delinquencies, to employment. But for those people who are performing, and whether or not they take on debt, the rate has an impact. And we're going to talk a lot about the rate environment in just a moment. But Jamie, and I go back to my training in credit, which is you always think about what's the worst case. Jamie's view is that the worst case from his bank, that is JP Morgan's bank, is 8% interest rates. Right? Treasuries today are a little over 5, something like that. Is that really bad? I mean, I look at that number and said, I remember my first mortgage was 9%, and I was very happy with that. So the world survives pretty comfortably. So is 8% really bad? Is that really the worst case, or could it get really worst case? So we're going to talk a lot about it, but just think about it as the worst case for the moment.
Yeah, I look, we've as a country, we've gone through far worse than 8%. I don't think anyone wants to relive those times. It was certainly before my, call it, adult financial experience when that happened in the early 80s, late 1970s. But it was very, very painful, and still kind of looked at with, as a case study of A, what to avoid, and B, how to handle it from a monetary perspective, Volcker and the very painful extrication from that, as I referred to, that wage price death spiral that really took hold. And so, look, I have that in the back of my mind as the worst, one of the worst economic cycles that we've been through in my lifetime. Obviously, people can also refer back to the Great Depression. I think the Great Financial Crisis is, probably a horse of a different color for a lot of reasons, as was the pandemic recession, which was very short-lived and had its own unique characteristics. So whatever the next bad thing is, it's going to be different. I will take Jamie's point, though, that, there are some, look, first of all, a lot of people who are in the workforce today, youngish people, have never seen rates at 8%. Large swaths of America have never seen that. And they grew up in a time when we were in this lower for longer phase, since the Great Financial Crisis, where they just think rock bottom rates is the norm. Most people don't believe rock bottom rates are going to be, most people I speak with don't believe rock bottom rates are going to be the norm, nor do they think that we're going to revert back to this lower for longer environment. Yeah, we might get back to lower rates, maybe even really lower rates, but not for the good reasons that we had, that you might argue we had, before. It might be because we're in a recession, right? That would be a bad reason to be at low rates. But that is nonetheless the context that a lot of people have, is like, wait a minute, what happened to my 3% mortgage? Now let me pause on that just to give you some context. I mentioned the refi boom. 75% had refinanced their mortgage. So today, if you take a snapshot of mortgages, 80% of them have a rate below 5%, 60% below 4%, and 25% of people with a mortgage have a rate below 3%. 3%. Yeah,
that's right.
Any of those handles on those is low by historical standards. And now all those people are locked in for 30 years. That is providing a lot of financial security for them as we navigate these higher rate environment. And if the economists are right, and we're in this higher for longer rate environment, that makes those mortgages that much more attractive, and they're going to want to hold on to that. And that has all sorts of negative knock-on effects to the economy, but it also has this positive effect that people have some buffer against the higher rate environment.
It's a really good point that you're making, that the overwhelming proportion of the consumers have seen not just lower rates, but actually have seen progressively lower rates. But that's the environment that would be the change has been for the lower of the rate. And I'm going to extend that, because you and I have talked about these problems in the past, and you keep telling me, never underestimate the creativity of the capital markets. That's true.
Yep.
But the overwhelming majority of people who are in the capital markets have also never seen an environment of higher rates. They don't know quite how to construct the instruments to get around that. So I'm a little less comfortable that the capital markets are going to come up with solutions to the problems that we have had in the past. But I'm going to leave that for the second. But we've talked for an awful lot now, and you've given us lots of good background. I think it's a time for us to talk about how you got to where you got to. We got to know each other because you were a managing director in structured finance. I was a managing director in corporate finance. You don't just show up and get one of those things. There's a lot of pain and suffering that you go through, and a lot of ups and downs and learnings to be able to get to those positions where you can exercise some judgment and have opinions and have people think about it. So talk to us a little bit about your background and what it was that kind of led you to where you are.
Sure. I mean, look, I'll kind of start. I'll go backwards in time. I think that's easier. But I spent the last 25 years until a year and a half ago, after I left Moody's. But I was at Moody's Investor Service. I was always in their structured finance team, and I was almost always focused exclusively on the consumer credit securitization or structured finance markets. So everything that we've been talking about are, germane topics to understanding how, on a much more granular basis, the related structured finance markets work. You have to understand the big picture to understand the more granular structured market. At least that's my firm belief. And in I started out focused on one asset class. Again, 25 years ago, credit cards. That was my sole responsibility, and just through the passage of time, got exposed to more and more of the consumer credit market. Within structured finance, within the industries and the issuers, as we call them, the originators of those assets, the originators of that credit, and then understanding how that then, and this is how you and I got to know each other, understanding how that interacted with other lanes of the capital markets. So you were in corporate, so you focused on corporate ratings. I focused on structured finance ratings. These are very different. They're very different calculus in terms of understanding the characteristics and influences to those credit stories and credit products and credit analyses. But boy, there's a lot of overlap too. Certainly, I learned a lot from working with you and your team and the corporate analysts in general. But it doesn't stop there, right? I mean, there's obviously that extends to people who run the sovereign rating team. That extends to people who run the project finance team and the public finance team. So that interaction with other teams really broadened my view and understanding of how the capital markets and the credit markets interact with one another. And I covered that not only for the U.S. but also for Canada, which is very interesting because that also has its own kind of fingerprints, right? That is a similar but different economy. They have different philosophy and kind of social norms around credit and credit extension on the consumer side in particular than the U.S. does. And that's manifest in the behavior and the underwriting. So you do have to understand those nuances. And similarly, I also covered our Latin American franchises for structured finance. And there again, each country in Latin America where we had a presence had its own take on credit, on consumer credit and how to finance it. Very different from, Brazil to Argentina to Mexico, for example. They have very different approaches to credit, I can tell you. And just learning about that was super interesting. So that was my stint at Moody's. Prior to that, which is now going back a long time, like I said, I worked at what is now called Morgan Stanley. Back in those days, it was Morgan Stanley, Dean Witter, Discover and Company. I think that was the full name. But I mentioned that because I worked in the Treasury group for much of that time there. And there I was exposed to kind of asset liability management analysis and techniques. And I had really my first exposure to structured finance credit and consumer credit on a more granular basis with the Discover credit card franchise, and how, a big multinational company like Morgan Stanley finances its, multi-billion-dollar credit card program was I had a front row seat of that, and that was very instructive. And they had other consumer portfolios that they financed. Obviously, they financed everything in the Treasury group. So it was very kind of, like I said, instructive and educational to get that perspective as well. I did realize though that as good an education as I was getting in that treasury group, that I was only going to get Morgan Stanley's view of the world. It was really hard. It was really hard to get like other perspectives. You could get it, you know, from the newspaper or maybe
Mm-hmm.
textbooks, maybe, but you weren't going to get the kind of inside view that going to a rating agency allowed me, where you really are in I would say a very privileged position when you're in any of the rating agencies, because you get access to, if you're working for a rating agency with a lot of market share, you get a lot of access to um, the market and market participants, and you're in a lot of interesting private conversations as to how companies finance themselves and how they tack and how they think and how they set themselves up for success, and sometimes how they set themselves up for failure. And so those are, really, that was the draw to get out of Morgan Stanley, was just to learn more about the world around me at that juncture in my profession. Honestly, I didn't think I was going to stay at Moody's for 25 years. I wasn't thinking that far
Yeah.
ahead, but I'm certainly look back with a great deal of appreciation for my experience there.
So let me let your mind take a little bit of a break before we get into the really tough questions, and allow you to be philosophical here, which we're entitled to with gray hair, because I know that the path you described, getting there, was still not a very much of a straight line. I know that you spent time as a reporter in the famous Star Ledger, which is a paper I don't even know if it exists anymore,
Not
but
a
I certainly
reporter.
remember
I wish
reading
I
it
were a
growing up.
reporter, but I was at the Star Ledger. Yes.
Right. Well, okay. So at that point in our careers, we embellished our resumes a little bit. Okay. But so, would you, giving advice to your younger self, knowing what you know now, for somebody coming out of college or coming out of business school, would you advise that person, maybe your younger self, to focus on consumer credit? That it's really, in finance, a great place to be. Number one, and in addition to that, if that's not a hard enough question to answer, what did you learn in covering your portfolios for all this period of time? And this is just a break, because we'll get into the tough questions in
Yeah,
just a
that's a
second.
tough one though. I wouldn't encourage or discourage anyone from getting into consumer credit per se. It's been great for me. I was it in undergrad. You know, I majored in economics. Um, I landed on that major after trying out several other majors and moving on from those, which were interesting, but they didn't hold my interest as much as economics did. And also, frankly, I was running out of time because I was going to graduate in 4 years, and I landed on economics. It had a great combination of kind of analytical rigor as well as kind of a touch of sociology, maybe even psychology, elements to it that I think, that softer analysis appeals to me as well, in understanding, the big world around me. So I think that I want to say that set me up for what was to follow on the one hand, but, it was just something that I thought was interesting. So I kind of go back to follow your interests in terms of advice. I wouldn't encourage or discourage anyone from consumer credit, except to say that, for me, and I think for anyone who's intellectually curious, that it's a very, very rich, diverse, and just like I said, endlessly interesting and changing um, uh, sandbox in which to play, and that's kind of how I've looked at it. And look, I like to be in an area where I'm going to be challenged. I like to solve puzzles, um, you know, and I think this career path and this field offers a lot of those along the way,
Mm-hmm.
and will certainly
Mm-hmm.
challenge anyone who's interested in pursuing that, that kind of a challenge.
And the bit of advice you're going to give to that person who you're going to say, pursue your
Well, I
interests.
would,
What did you learn?
I would say this to any young person, and I have a couple of sons who are, just in college. One's going to graduate this year, and the other one's sophomore. But I tell them, as I would tell anyone, is that get as much exposure as you can when you're young, and even bad experiences are even so-called bad experiences are an experience from which you can learn and develop from. Um, and so I think, again, part of my thinking when I moved from Morgan Stanley to a rating agency, Moody's, was to get that exposure because I knew that's where I could grow faster, could learn. I would be exposed to more, and I could learn faster. That sounds like I had a master plan in mind. I didn't. I just was taking that kind of stepwise, what I thought was a smart move. And I think it was a smart move, but you can't be sure that all of your chances in life are going to be a step in the right direction. They might not be.
Good background. Great. We've been talking for pretty much near an hour now, so we have a lot of things to. So I'm still on the first page of my notes, by the way. I have
Oh
4
my
pages,
goodness.
so we're going to try to truncate this a little bit and get just a couple of more points to lay out there. But I want to talk about interest rates actually and how that affects the consumer credit, which is a topic that has been really important to me. And we all know the consumer price index releases last couple of months, several months, have been well above expectations to the point where the market at the beginning of this year thought there were going to be 6 interest rate
Right.
cuts. 6.
I think it's down to
And
2.
today, well, I think the average is 2. Bank of America said 1. Goldman said 2. Um, and I think the Minneapolis bank president said, well, maybe none at all. And maybe we actually have to increase rates. And so, with this rapidly changing market sentiment, go back to the point that Jamie Dimon was making, is that the market may not be right. Um, what's your sense about the forward consumer credit environment that is over the next year or so? And you referenced this point about soft landing, which the markets have talked about for years, by the way. And I'm increasingly hearing no landing, meaning not a soft landing, no
Right.
landing, meaning we're kind of stuck in this conundrum and use the word paradox of relatively high interest rates, relatively low employment, for which the Fed can't do much about. Meaning, it can't really do the kind of monetary policy that it's wanted to do because rates are so high and inflation is so high. So, with these high rates likely not to go down, meaning not spurring the economy, what do you think the sentiment is for consumer credit going forward?
Well, one number that comes flashing into mind immediately, is maybe emblematic of the rate environment that we're in, and the trajectory that I think, to the surprise of many, we are now. Well, that just an example of the volatility in these rates and how meaningful they are. I think the 30-year fixed mortgage is now well over 7%. And, that is anything above 7%. Well, that was thought the new ceiling. And now we're well over that. And current, again, as a consequence of the print last week in inflation rates. So I'm trying to think of the best way to frame this, the consumer sentiment. Well, maybe this way is the best. Let's look at what consumers are actually saying. I've written about this in one of my newsletters, and there's a couple of different surveys out there, each of which I won't go into the details of, but each of which has their own, call it, biases. Some might say flaws. But what is remarkable, and I think University of Michigan survey came out just recently and showed a tick down in consumer sentiment. And I think it had been ticking up a little bit recently, but consumer sentiment is surprisingly weak. Again, I think, and not only that's not only the current sentiment, but also I think they have a question about the sentiment about inflation, for example, out a year from now. So also a forward-looking sentiment, also weak in historical terms. So many people have asked, like, why is that? Why are consumers so down on the economy when they're the job market is so strong and all these other measures are quite good? And I think, the answers that are coming back are, some of the topics that we've already covered around inflation, rents I mentioned, certainly certain grocery items come back or come into the headlines every now and then that aren't that consequential in and of themselves, but become kind of symbols of what inflation is having as a kind of psychological impact. Remember, I mentioned, psychology does come into the picture here to some degree because people have a very firm memory, it turns out, of how much eggs cost, 3 years ago. And then when they come into the grocery store and they see that it's a multiple of that, they're freaking out. That's right. And another kind of consumer expenditure item of consequence is gasoline prices at the pump. And those are ticking up now again. Right. So I think on a national level, we're approaching $4 a gallon, at across the country. And that's another kind of psychological threshold that if we do pass that threshold, that's going to weigh negatively on people's sentiment. Okay, I could keep going on about that negative sentiment, but I think what's interesting to me is that despite the negative sentiment, we're seeing consumers continue to spend and again, spend it at quote unquote healthy pace. I won't comment on the credit quality of that growth. Just, we've already talked about that, but it is certainly driving the economic growth that we're seeing. That is very healthy, very strong. So the confidence in terms of putting their money where their mouth is, yes, there's a lot of negative consumer sentiment out there, and yet they're still spending more on credit. There must be some level of confidence that they can weather this economic storm, or they wouldn't be ramping up credit. You can argue. Okay, that's one argument. By the way, I understand that's the argument that there's the ability to repay out there. There's also, an argument out there that people are buying on credit because they have to. So again, we're going to come back to this theme. It's like the tale of two cities, the tale of two borrowers. You have the people who are very, very resilient, the homeowners, I'll call them, who, by the way, are wealthier and drive a much, much greater proportion of the consumer spending that I'm referring to comes from the wealthiest cohorts. And then you have everyone else who's, living paycheck to paycheck still. They might be ramping up their credit balances because they need to, because there's no other way to make ends meet. So I think you have to think about both sides of that.
It's very complicated. And
that's not going away anytime soon.
Not going away anytime soon. I'd certainly like to understand why the price of eggs is what it is, and why a loaf of bread is $6 and chocolate is 5 times what it costs just 18 months ago. Because I don't have a good explanation for all that.
The chocolate, I know the
And
chocolate is there's a shortage of the what is it, the cacao beans or what have you
yeah,
globally, right?
yeah,
I think because of
that,
weather,
yeah, but
I think it is.
because of the weather. But interestingly, that's true. There's a shortage of supply, but the price increases are not reflective of that shortage of
Mm,
supply. In other words, the price of chocolate to the consumer has a multiplier relative to the supply. And that was one of the issues during the early stages of the pandemic. Prices shot up. Prices shot up on goods because people shifted from services to goods because they were home and they had to buy stuff. And that created all kinds of problems with the supply chain, which was very finely tuned to a very modest but predictable growth in the supply of goods. Well, that changed a lot of things around. That's basically solved. I mean, there's always going to be supply chain interruptions, but that supply chain issue is basically taken care of. So I actually don't have an answer for why prices keep going up on these core commodities. Maybe you do. Maybe you
I mean, I think
know.
you're right. Supply chain just disruption is no longer really a factor. But one thing
Nope.
that remains a factor, and I you have to put an asterisk next to that too, because there is some certainly transportation on the margin issues going on with again the geopolitical situation in the Middle East disrupting Suez Canal traffic through the Suez Canal. You know, you could even, if you want to get a little more micro about it, you could talk about the what is the Key Bridge collapse in Baltimore. You know, I think that's not going to have any kind of perceptible macroeconomic consequences, but on a microeconomic basis, that certainly is having an impact for certain types of goods that were concentrated through that port of entry. Um, but so there's a little bit of that. But what hasn't gone away, our labor costs are certainly higher. That's sticky. I mean, again, have not to the point of where we're talking about wage price spiral, but wages, it costs more for everything. It costs more for everything. And actually, a good kind of another thing that I wrote about in my Consumer Credit Matters newsletter was around um, auto insurance premiums going up,
Oh
right?
my gosh.
So auto insurance
Mm.
premiums, I think I can't remember if it's the last 2 years or 3 years, have gone up 46%. And then you might say, well, why? Well, why is that? Why is that happening? Well, okay. Well, one of the obvious things is, well, the cost of vehicles has gone up, right? Inflation really hit new car and used car prices for an extended period of time. Okay, uh, so insurance companies need to price in the cost of a new vehicle for accidents, and that's one point. Second point, labor costs to have maintenance went up as well as labor costs for virtually everything went up, and that's not going to go back down in anytime soon. Parts uh, parts supply, those parts, for all the reasons we've talked about, are also still relatively expensive. And here's the thing that I learned about when I did that analysis that I did not anticipate. All those things I could have anticipated, I think, and some of those probably are going to come back down a little bit and already have in some cases, certainly inflation rates on new and used. And that is people are driving are riskier drivers, it turns out, today than they were
Mm.
prior to the pandemic. And so,
Hmm.
you know, they're driving around um, more expensive vehicles that are harder to maintain, more expensive to maintain, and harder to get procure parts for if they get into an accident or what have you. And they're driving, behavior is riskier. And they're getting into more accidents, it turns out. All of these things are compounding to create a bit of a game of catch up on the part of the auto insurers to increase their premiums by, like I said, 46%, a rate, no matter how you measure it, that is far and above what we're seeing in other categories of the inflation report. In fact, I will point this out: the inflation report, this last print last week, car premiums, car insurance premiums, and I think also maintenance. vehicle maintenance were continue to be two standout, meaning really high sources of inflation. And so that is a story or a narrative that I think you can expect to continue as the insurance companies need to reprice their businesses to maintain the margins that they were achieving, in years past. And you can imagine, think about how often you write your check to your insurance company. It's usually once every 6 months or maybe once a year. So there is a decent lag in the repricing of those insurance policies. So I would expect actually this pressure of outsized inflationary spikes to the auto insurance premiums to continue, at least for several months more. And you don't think about that as a consumer credit item normally. It's not even directly built into your debt, but it certainly is another check, a higher check you need to write each month or every 6 months. That takes a bite out of that personal disposable income that you didn't need to spend it.
It's a contingent obligation, is what it really is. You can't get a car loan without
Right.
insurance, and that insurance is higher than what you would expect.
And that's auto insurance, and it's on an even bigger scale when you look at it with respect to homeowners insurance.
Homeowners insurance. You're right. Well, we've covered a lot of ground, and I still have a lot of really interesting things to talk about. But maybe we can conclude. Maybe shift gears and talk about one topic that I think is going to be interesting to everybody, which is this, which you've written about, which is swipe fees,
Oh yeah,
which are annoying to all of us. Is what they are. Um, the agreement amongst the retailers and the swipe community, I'm going to call them, which is this whole chain of credit card issuers, the banks, processors, Visa, MasterCard, merchant acquirers, and others in between all that who carve up a few pennies on every dollar. The agreement to reduce those few pennies, and I think the retailers argued it was a consumer win because the retailers are going to have the opportunity, let's say, to give it back. I personally don't think they are going to give back a penny, but I'm curious what you think about this. Is this a win for the consumer? Is this a positive? Or does it positively affect one of your former employers? You mentioned you were involved in Discover. They were purchased by
yeah.
Cap One, which could have been just under the radar as a normal portfolio purchase, but really what Cap One got was the processing network that Discover had, which could very well be very valuable going forward under this new regime. So, summarizing here, as our last point, what do you think about these swipe fee things, and should I, as a consumer, feel good about it?
Yeah, so there's a lot to unpack there, just because there happens to be a lot going on in the marketplace now around swipe fees. So I'll touch on a few of them that you referenced. I won't get into the details of the Dan. You did a pretty decent job. There's a lot of complexity in the number of participants, and the simple act of using your credit card for a purchase, either in person or online.
Far more hands out.
There are a lot of hands out, yes.
There's a lot of hands out than you think
Right.
there are. It's a lot more than what Visa and MasterCard.
And as I'll get to, it's an ecosystem that has grown up over time, and it's very sophisticated and funds a lot of different aspects that, again, you may not appreciate as a consumer.
Right.
So first of all, what are swipe fees? Just to put it into context, they are roughly 1 to 3 percentage points of the purchase price at the point of sale. So if you spend $100 on a sweater and you use a credit card, 1 to 3% of that, $1 to $3 of that sweater will go to any number of participants. Most of it goes to what's called the issuing bank. So if you have we'll use Discover. If you have a Discover credit card, it will go. Most of that swipe fee will go to the Discover bank in that case. But some of it goes to the network, which the networks that are most familiar to us are Visa and MasterCard. But Discover has its own network, its own proprietary network, as does American Express. So those are the four big networks in the U.S. And people often refer to the networks as the quote unquote rails. Basically the path through which purchases, credits, and transfers get made from all of the kind of ecosystem of actors who touch the transfer of funds along the way. Okay, so what's happening with swipe fees? A few things. One is, most recently, there was a lawsuit settlement between Visa, MasterCard, and a merchants group, where Visa and MasterCard agreed to lower their swipe fees as a settlement. I'll come back to that, but that's the most recent event when it comes to swipe fees. I would argue that this is probably a more marginal, call it even imperceptible, to the typical consumer kind of change, but it could add up when you add up all the trillions of dollars of expenditures that are done on credit. It could add up to a meaningful amount of money to the merchants from whom these swipe fees are taken, you could argue, right? Because they're not getting 100 cents on the dollar for their sweater in my example. They're getting 97 cents on the dollar for their sweater. Okay, so that's one kind of current event. The other current event that's occurring, as we speak, is there is an act in Congress. It's called the credit card. What is it called? Credit Card Transparency Act. I don't think it might be the CCTA. I can't remember, but it has credit card in the name. I remember that, and basically it is an act. It is a bill that has bipartisan sponsorship that seeks to introduce or mandate competition among these networks that I mentioned: Visa, MasterCard, Discover, and American Express, by essentially allowing merchants to decide at the point of sale which credit card network they want to run the credit card through. So as an example, if I show up with a Visa card, but the merchant says, well, I know if I run this on the Discover card network, it's going to be cheaper. They're going to take less money by virtue of the swipe fee. They can program something in the point of sale that says, okay, I swipe the Visa card, but I'm going to run it through the Discover card network, okay, which is cheaper. So the merchant captures more money on the margin from each of their sales. And the thought is that this is money that will, help small businesses, because this 1% to 3% adds, it adds up for them because they have thin margins to begin with. And B, it could also be passed on to consumers by way of maybe cheaper cost of goods, right? That's the theory. I do get a little concerned about having such a heavy-handed, law in place that meddles with an economic, an ecosystem that has been worked out over decades now, and is, as I said, is very, very complex. And there's no doubt in my mind that if you push on this area, that there's going to be unintended consequences. So what can some of those unintended consequences be? One is that one of the things that probably the largest category that swipe fees go to help pay or subsidize are rewards programs, which a lot of people like. And so if you take away that source of revenue to pay for or subsidize the rewards programs, then either those rewards programs are going to be less generous in the future, or the credit card companies are going to find another way to exact a charge. Maybe it's a higher annual fee or whatever it is to maintain the levels of reward programs, or maybe somewhere in between. But the point is that, credit card companies are in the business of preserving, if not expanding, their profit margins. They're not just going to, say, oh, well, I guess we lost that one and move on. There's going to be something else that happens. And so that could upset that kind of very large economic incentive, the economic environment there.
Mm-hmm. Mm-hmm.
So that's something I would definitely watch, is the development on that Credit Card Transparency Act, as I mentioned.
Good. So am I, as a consumer, going to get any benefit out of this?
No, I mean, I very much doubt it. I think that's a false promise, and I say that with confidence because about 10 years ago there was a so-called Durbin Amendment, so something very similar to the CCTA that was successfully crossed the finish line. It became law that reduced fees not for credit cards but for debit card expenditures. And one of the feds did a nice kind of post-mortem analysis several years later to determine whether any of that savings, the lower swipe fees for debit card purchases, was passed through to consumers by way of lower consumer goods, cost of consumer goods. And the answer was no, pretty much. So yeah, I wouldn't expect there to be anything. I think that would be, if there are any savings to be had because of a law like that or a change like that, I think that will in all likelihood be captured by the merchants and not passed on.
I'll have to start paying more with cash from now on. More with cash than I
look, I'm
already
seeing,
do.
I don't know about you, but I'm seeing, increasingly, it's not everywhere, but I don't want to exaggerate, but I am seeing more often than I used to signs in the door that offer, a different, actually the way it usually is phrased, although I'm not sure this is in accordance with the network agreements, is that they'll charge you basically a fee if you want to use a credit card. So they're going to pass that fee on to you, and they'll tack it onto your bill if you want to use credit. If you pay with cash, then you pay a lower price. And that's been around for a long time at the gas pump, right? We all are probably familiar with that. You pay one price for cash, one price for credit. So maybe consumers have been trained to expect that, and they don't offer it they don't characterize it as a fee. They characterize it as a discount for cash, which is probably not by accident. That probably is allowable by the network agreements, I suspect, with the merchants. But they have a very simple menu where this can be managed. They pretty much sell only one thing, so it might be more complicated to roll out in the more dynamic consumer world.
Well, the cash economy is not completely dead, and the other advantage is it helps me with the tip,
right?
Because a 3% increase on top of a bill gets added into the tip anyway, so I can control it.
There you go.
We've covered a lot of territory. We have a lot of things still to talk about, which is wonderful that there are a lot more podcasts coming out. Anything that you want to close up with in terms of content that we covered, not covered, something for listeners to look forward to? What do you think?
No, this has been great, Bob. So I really appreciate it. I know you well enough to know, and I know, there's a ton more we could talk about, and we probably will talk about, again, when we kind of turn the tables and we talk about your area of the world. Like I said, there's a lot of intersection there, a lot of interesting things happening. I think this was a very, robust conversation in and of itself. We've gone on almost for an hour and a half now. So I think that we'll call this a part one. Maybe we'll do a part two some other time, but it's been great.
A lot more to talk
really
about.
Looking forward to our next conversation. So thank you.
Well, it's good that we still have the stamina. We're going to keep on going.
Thanks.
All right.
Bye for
Thanks
now.
a lot. Bye-bye.